The COVID-19 pandemic caused economies to contract. Then the virus subsided and economies grew much faster than anyone expected. Prices of goods and services rose higher and higher in a short amount of time, and some people weren't able to cope. There was a mismatch between supply and demand. Someone had to step in and curb the phenomenon we now know as inflation. So who does that and why? It's the central bank, so that we can all stay a bit more zen. Hi, I'm Roshan Gidwani, and on this episode of Finance Zen, I will be telling you about how central banks curb inflation. For the most part, a central bank is an independent institution that manages the currency of a nation. In America, the Federal Reserve is the central bank, and it's been raising interest rates to help curb inflation. This makes it more expensive for people to borrow money, which slows economic activity down. People aren't borrowing money to buy new homes, for example. Thus, the rate of expansion and growth are less, and inflation is reduced. The Fed can also use quantitative easing to curb inflation. This is when the central banks purchase government bonds and other financial assets in order to increase the money supply. This way, the financial system is more liquid and economic growth is stimulated because banks can then lend or invest more freely. As a result, interest rates can be reduced and people can borrow more easily, which reduces inflationary pressure. In Singapore, the central bank is the monetary authority of Singapore. It may use fiscal policy to help curb inflation. For example, in October of 2021, the MAS slightly increased the rate of appreciation of the Singapore dollar. Almost all of Singapore's daily necessities are imported, so the MAS in Singapore adjusts the value of its currency to ensure that imports are not expensive for locals and that exports remain competitive in the global marketplace. This way, the cost of living does not rise dramatically for Singaporeans. When purchasing power is reduced because the prices of goods and services get higher, there will be a recession. So if gradual inflation doesn't occur, it's not exactly healthy for an economy. If we want to keep growing, the economy must continue to grow. So if businesses stop taking out loans to expand, then the economy doesn't either. That's why central banks must always be on the pulse of inflation to manage how much money there is in circulation, and that way they can track a healthy rate of inflation so that we're all coping and growing. I say reasonable inflation is a normal process. Adapt to the trend so that you can stay zen. Ciao!